I just want to give you a bit of a background before we jump into the presentation on myself. I started my career about 20 years ago with UBS here in Sydney. I was covering consumer goods companies such as Burns Philp, Goodman Fielder, Coke and Foster's. And I actually remember my first stock under sole coverage was British American Tobacco, so it's really showing my age here. You know, given my stocks had overseas operations and competitors based overseas, I always looked at those global comparables to benchmark my views on domestic stocks. However, I started investing directly in global stocks in 2006 along with Eric. And you know what, over the past 12 plus years, I've been growing increasingly convinced that there's a vast opportunity set out there that the typical Australian investor is just not getting exposure to. I've been with Ellerston for almost 3 years now. Before that, I spent 6 years managing a global portfolio for a large family office based in Melbourne. And you know, with that family office background, I really am just as focused on capital preservation as I am on capital growth. So it's really great to be here with you today. It's really great to have that opportunity to talk about the global mid-small cap universe and why it should be part of any domestic investment portfolio, along with Mary's Asian fund as well. The global equity landscape is vast. You know, you have developed markets, emerging markets, large cap, mid cap, small caps, and it can be really daunting for those that have never invested outside of Australia before. And as Mary pointed out, the natural starting point for many domestic portfolios is predominantly Australian large, mid, and small cap companies. So what I'm going to do today is put the global mid-small caps in context, to put it in size context for you. And also, we're going to spend some time, a pretty exciting time, talking about a long-term thematic that we're participating in and several companies that we're invested in to enable that participation in that thematic. Those companies have long-term tailwinds and catalysts for continued share price growth. So with that, let's hop into it. So firstly, to put into context, you know, when I talk global mid-smalls, some of the feedback is, you know, are you talking about these really small market cap companies? And they would carry a higher degree of investment risk. You know what, actually it's quite the opposite. When we talk global mid-small caps, we're looking at companies with market caps around US $10 billion and below. And to put it into context, I put a few on the slide there. Zayo Group, they have around 8 billion market cap, US dollars. You have Teradyne at around a little over 5 billion, and Huntsman at around 6 billion as well. So when we're talking those global mid-small caps, we're talking similar sized companies to some of Australia's great success stories, like Cochlear Group, the Australian Stock Exchange, and Treasury Wine Estates. These companies would be considered large and safe in many domestic portfolios, and yet in our world, they're actually classified as global mid-small caps. So to put it into more context, you think of Zayo. If it was actually listed here in the Australian market, it'd be a top 50 stock. It'd be bigger than Computershare, bigger than the AMP, and bigger than the Stockland Group. So with that, now that we've kind of talked about the size and what we're looking at, they're not micro cap or very small cap companies, they're sizable companies. So what we want to talk through now is a little bit more about the diversification benefits for your portfolio as well. You know, Australia does have some great companies, as highlighted on the chart, but you know, it's an increasingly globalized world, and some of the best investing ideas on the planet and some of the strongest investing trends are not actually accessible here in the Australian market. So as this chart highlights, there's a large opportunity set overseas in terms of potential investments. You know, as we focus on the left-hand side of the chart there, that's, you know, basically the mega cap companies. We're talking companies 10 billion, market caps up to over $200 billion. You know, it's a category that's just over 1,100 stocks, and there had been a race on to be that first $1 trillion company. You know, Apple beat Google and Amazon out of the gate there, but those companies are incredibly well researched. They're really well known, and you can get access to them in some great funds. You can get access to them in ETFs, or you can invest in them directly. In terms of the coverage, there is a massive amount of coverage on these stocks. It's interesting that just the other day there was a brokerage house in the US that initiated coverage on Apple. And I had a look, and there's over 50 analysts already covering Apple. And I'm thinking, you know what, I'm sure it's very good and insightful, but what's the 51st or 52nd new analyst going to add to that? So I do find it's kind of hard to get the edge in that category of the market. As we move over to the right-hand side of the chart, you see there's over 8,000 stocks. Those are the global mid-small cap universe. It's over 7 times larger than that mega cap. And yet, you know what? It's actually a lot less covered. Sometimes there's companies in there that might have 1 or 2 analysts that cover the stock. I really do believe that for those willing to do the work, there's an incredible opportunity set there to harvest. When we think back to those success stories of the ASX, Cochlear, and Treasury Wine Estates, they're incredibly well-run companies. They've generated significant compound growth for shareholders over the last few years. In our world, they're mid-small cap companies. And I'm very firmly convinced that you have that exposure here domestically. You should have that exposure overseas as well. However, one thing that is clear, it's very hard to know where to find those companies and get exposure to those companies as well. So let's talk about the long term and future-proofing your portfolio. This chart, it's thought-provoking and amazing at the same time. If you look at it, what it is, basically it's showing you the average age of a company on the S&P 500. And what's happened over the last, since the mid-'80s till today, the average age has dropped from over 30 years down to 20. And that may be because of disruption. When you think about Amazon's, moving through the retail landscape, you've had a lot of business models which have been disrupted. You could have M&A in there, or you could have businesses which had poor capital structures as well. But what's happening is the average age is declining. And when you think about that, every 10 years, roughly half the S&P is going to get replaced. And what replaces them? Global mid-small caps of today. So if you're not investing in those global mid-small caps, you may be missing out on those large cap investments of tomorrow. There's studies out there that with the technology change that we're seeing today, that pace, that average age could actually get condensed to a little over a decade in the next several years. Now, at the most basic level, when you think about the global mid-small caps, they typically offer higher growth than many of the large cap counterparts. And that is a function of they may have large market shares in underpenetrated markets. They may be enabling current technology or developing future technologies, or they may be solving some of today's large issues in large established markets. And we'll touch on each one of those later in the presentation. One thing that I'd like to point out, it's amazing to think that both Amazon and Netflix actually started their lives in the mid-small cap space. Amazon listed in 1997 with a market cap a little over $400 million. And that's a far cry short of their close to $1 trillion market cap today. Clearly, over the last month, that's come down a bit. Netflix was a mid-small cap up until 2013. At the end of September, there was a $160 billion market cap. So don't feel sorry for little Netflix there. It's just that scale of the market overseas. When you think of $1 trillion market cap companies. And that's why for us, global mid-small caps around that 10 billion are sizable opportunities overseas. So historically, before I jump into the next set, one thing that is quite clear that the domestic investor has had a real massive home bias. You think of superannuation, you think of your personal accounts. They've really been levered to the domestic exposures. And I think over time what that has resulted in is a significant opportunity cost for those that have been chasing yield. They haven't been getting the diversity and growth that you get with the offshore companies. And that's what we're going to talk about now. So this is something that I think we're going to be talking about for the next decade. I hope I'm lucky enough to come back every year and talk about how this is transitioning. I do believe we're at the cusp of a major technological revolution, and it's going to be broad-based across many industries. That technology change is going to be enabled by 5G. And this is what I'm talking about here. So this is a chart showing different compute cycles. And the most interesting aspect of this, every cycle generally dwarfs the last by a factor of 10. When you look at the PC cycle, and that's basically going from the mainframes to the PCs, that was represented by hundreds of millions of units. Move to the mobile internet, basically your smartphones, and we're talking billions of units with the smartphones. And whilst that has plateaued somewhat, that still continues to show growth. Now the next cycle is the most powerful and long-term in terms of its trajectory and most pervasive across industries. And that's going to be driven by data. So what we're going to see here is a market size that's going to be 10 times the size of smartphones. And with that, it can only be enabled by the 5G. The most interesting aspect of this next cycle, it's all being driven by data, and it's going to be driven by multiple technologies converging at once. We talked about the PCs, one layer of technology. We talked about the smartphones, one layer of technology. This next cycle is going to be driven by the Internet of Things. And when you think about billions of devices being connected to the network, When you think about artificial intelligence and machine learning, it's been around for a while, but now it's going to be enabled at scale. When you think about virtual reality and augmented reality, real buzzwords out there, those are going to be, in terms of the growth of those applications, they're going to be exponentially compounded with the advent of 5G. And all this is going to be underpinned by automation. When you think of automation, it's going to supplement human and business operations through robotics. But like I say, it's important to note that none of this is going to be enabled without a robust and scaled 5G network. And when you think about the 5G network, it's going to take some time to roll it out, I'll admit that. But what it's going to do, it will enhance your mobile experience. But what it's going to really drive, when you think about it, is autonomous driving. It's going to really drive artificial intelligence, machine learning, and it's really going to drive the industrial Internet of Things. 5G over time is going to be like electricity for us. We're going to expect it to be on and fast wherever we are. And I can say 5G and all that, but you say, what does it actually mean in terms of size and speed? When you think about a 3G network, if you were to download a high-definition movie on a 3G network, it would take you over a day. Remember that spinning wheel of death while you're waiting for that video to download. On a 4G network, it takes several minutes. On 5G, a couple seconds. So it just shows you how that is scaling over time. And as that compute increases in speed, the cost of it comes down. And that's what's going to enable all these new technologies. When you think of 4G, it enabled Netflix. Like Netflix wouldn't really work without a 4G network in place today. And we really don't know what the 5G killer app is going to be, but I've got a firm view that it's going to have much broader implications. I don't believe it's just going to be consumer-led. I believe it's going to be industrial-led. It's going to be across manufacturing, healthcare, transport, you name it. It's going to be a broad-based application that we're all going to benefit from. It's interesting. There's studies been done about what 5G alone, as it's being rolled out, in terms of spend on infrastructure, what it could add to the global economy. And IHS Markit estimates that it could add the size of the economy of India over the next 15 years to the global GDP growth. It's incredible to think what the scale of this could be. 5G is going to be this technology platform that's going to connect cars and cities, hospitals and homes and people to things, to everything around them in more meaningful ways. But you know what? Implementing any of these 5G use cases that we've talked about, it's going to be very difficult, and it's going to require a lot of research and development and a lot of spend on communication services. And with that, it's really hard to pick who's going to be the winner from this big trend. And for us, what we know from talking with our companies and listening to other companies, every company on the planet is developing a digital strategy today. It's not a question of if our business could be disrupted or if we could fall behind our competition. It's when and how are we going to stop that. And it's not just the CIOs, as Chief Information Officer's discussion anymore. It's right up at the CEO level right now. And that's going to be driving all these companies spending on R&D and understanding where they're placed in this technology cycle. So what we like to do, we like to buy companies that are providing what I like to call the digital picks and shovels. Companies that are enabling and helping develop these trends rather than trying to pick the winner, because right now it's very hard to determine. But you know what? No matter who wins in this 5G land grab, one thing is for certain is data and data growth is going to continue to grow strongly. This is a chart. I was at a conference. This is back in not too long after the GFC. And it was a conference at a UK data center owner. And you know what struck out me at the time and since then, he put the chart up and he says, show me where the GFC is. And you look at this chart of internet usage and you cannot see where the GFC is. That is a powerful underlying demand dynamic that was underpinning a lot of those companies at the time. And I'll admit, during that time through the GFC, the share prices fluctuated a lot. We know what the economies did during that time. But at the end of the day, the real business drivers of these companies were actually accelerating through that time. Now, you look at little 2012 there on this chart. This is a chart of data generation over time. And with the advent of 5G, with artificial intelligence, with machine learning, with the industrial Internet of Things, you can see what's being guided to in terms of data growth over time. It's incredibly strong thematic and one that's going to be driving a lot of business models over the next several years. So now let's talk about how we're participating in this. I'm going to talk about a few companies here that are really underpinned by this strong data trend. And the first one I'm going to talk about is Zayo Group. So we talked about the digital stream, we talked about the mobile traffic, we talked about the driving growth in the bandwidth. What Zayo has here, they're a large infrastructure owner of fiber assets, predominantly in the US, but they also have operations in the UK and Europe as well. Think of what we've seen in the past few years with Netflix and Spotify, Amazon and the other large cloud companies really driving bandwidth growth. That bandwidth growth that we've seen in the previous slide is probably going to accelerate from here. With bandwidth, you need fiber. So the way I like to think about it, fiber is to bandwidth as what the road is to cars. Without fiber, bandwidth can't move at speed and can't provide these innovations that we need for tomorrow. I like to think of fiber as this infrastructure which supports future innovations. But what's interesting? Fiber is actually becoming increasingly scarce. There's been a lot of consolidation over the past few years in terms of fiber. There's been large tower companies buying fiber assets. There's been strategic investors buying fiber assets because they see what we're seeing. They're seeing that data growth. And they understand that these assets are very hard to replicate. I know it's a very crowded chart on the right-hand side there, but when you look at New York, Chicago, and San Francisco there, imagine trying to dig up the streets and laying fiber in those cities. It's virtually impossible today. So the incumbent owners of those assets with this demand driver behind them are becoming incredibly valuable. So another company I want to talk about is Interaction. I'm sure you've heard of NextDC here in Australia. The way I like to frame it is Interaction is basically the NextDC of Europe. It owns over 50 data centers across the continent. It serves over 75% of European GDP. It also benefits from this data growth, but the beauty of their business model is roughly 70 to 80% of their growth every year comes from companies just growing inside their existing facilities. Mary mentioned Tencent. Tencent chose Interaction's Frankfurt facility as their foundation for their European cloud strategy. The other aspect with Interaction, with this demand that's really driving the business, they've announced capacity additions of over 30% over the next 18 to 24 months. And you know what? Several years ago, that would have been viewed as a negative because there was a worry about overbuild, but because demand is growing faster than what you can put new facilities in place, they're actually getting pricing power today. 2 nights ago, they announced additional capacity additions. They're actually going to grow their business by 45% in the next 2 years, and a lot of that is already underpinned by existing customers contracting with them for that future growth. 95% of Interaction's revenue is recurring. I love businesses when you open up the door each year, 95% of the business is already there and can be growing with existing customers inside there. It's interesting, it's growing top line at mid-teens today. And that's despite the business actually doubling in the past 4 years. The past few quarters has actually accelerated its growth. And we recently talked with the company, it's about 3 weeks ago now, and the big takeaway was we're seeing a step function change in demand. Before it used to be 2 or 3 cloud players when you think of the Amazons and Microsoft Azure and Google, growing and building inside 4 of their big facilities, or big countries I should say. Now they're seeing 6 to 8 cloud players deploying across their entire footprint. It's not the demand that's holding them back, it's getting access to supply. And that's why they're announcing these new capacity additions. Another way I like to think about Interaction, they're building the digital factories, which are underpinning the internet of today and all these new innovations of tomorrow. And Interaction is very similar to Zayo. It doesn't matter who wins in all this. Infrastructure owners like this, with assets that you incredibly hard to replicate, will only win with the amount of data that's going to have to be driven through their assets. I'm going to change gears a little bit here and talk about a company that's actually enabling. It's a testing company. They're based in Santa Rosa, California. It's a company called Keysight. Keysight was spun out of a much larger company called Agilent a couple of years ago. It's got a net cash balance sheet and trades at 9 times EBITDA. And that 9 times is going to sound pretty cheap to you when I tell you what they do. So they're the largest electronic test and measurement company in the world. They have close to 25% market share. They're the largest player in 5G testing. When you think about what we talked about with all these new applications that come through, when we think about what it needs from a 5G network to make it work, Think of security. Think of all the spending in R&D to put all this together. It's very difficult. And we're at the very first innings of all this. And Keysight sits at the epicenter of this megatrend globally. The key point to keep in mind is all this spending is not just based on the 5G network itself. It's based on all the connections. It's based on all the cloud coming together and all the things that are going to connect as well. It's going to take a lot of robust R&D spending to make all this work in a secure manner over time. Keysight's also the #1 player in autonomous car testing. It's the #1 player in electric vehicle and battery testing. And when you think of what's happening today with all the large OEMs spending aggressively on autonomous driving, think of the Googles with Waymo spending on autonomous driving. All the tier 1 suppliers are spending in this area as well. These guys are the #1 player participating in that. And last but not least, they're the #1 tester in aerospace and defense. So when you think of what's happening with technology spend in aerospace and in defense, it's really becoming electronic warfare, the radars. It's one of those areas that's moving from the ground to the smarts. The Department of Defense recently renewed their budget for next year, and guess what? A lot of it is on technology spending. Keysight's the #1 player that's participating in that trend. And I want to cast your mind back to that chart with the S&P 500 in terms of the average age. And why that's important is that just 2 days ago, Keysight was announced as entering the S&P 500. The company was taken out. It's called the S&P 500 for a reason. We need new companies to come in. So I think it's a great example how a mid-small cap company can become a large cap company. So it's actually now in the S&P 500 today. So last I want to touch on a company called Ciena. So Ciena is a leading company in terms of optronics. And basically the way I think about it, it's just a company that moves data further and faster than ever before. And when we talked about Zayo earlier with the fiber is great, but you need to light it up. You need to make it work. And then Ciena is the #1 player globally that does that. Again, a net cash company trades at 8 times EBITDA. It's got the #1 share with web scale players like Amazon, Google, and Facebook, with all about 30% market share globally, helping them connect all their data centers together. All these data centers that they're building have to talk. It's about connecting content with content, and Ciena is the #1 player globally with 30% share doing that. Additionally, a lot of companies are developing and building these subsea cables. Just the other day, you might have read that Superloop's Indigo cable landed in Sydney. Ciena has 50% market share, 50% market share in making that work. So when you think about what's happening with all this data being transferred around the world, this company is the #1 player with a dominant share, and it was 30% share a couple of years ago. So you can see they're actually taking a lot of share. Every year they take about 1.5 to 2% market share, and I think that's going to probably accelerate given the technology they've got today. Ciena's business is driven a lot like the other ones in terms of video, 5G, and latency. Basically anything that requires higher bandwidth, and that's a long-term structural driver for this business. So what I've done, I put them together in a circle of opportunity and circle of excellence, I like to call them. So when we look at where they're placed and how we're participating in the Ellerston portfolio today, we're in 2018, this is what's in front of us. Bandwidth growth, data growth is the main driver of all these businesses. I didn't talk about Cellnex as much. I would love to spend a lot more time on that. It's the largest independent owner of mobile tower assets in the European market. Again, a business that's driven by this long-tail trend and essential infrastructure. And I'm not going to try to say that they wouldn't be impacted by economic uncertainty. Sure, they would. But one thing I do know is that the main driver of their business has got a long-tail trend ahead of them. These are strategic assets. Some of them are essential infrastructure. Some of them are enabling current and future megatrends. And pretty exciting to have them as part of the portfolio. So now that I've talked about a big thematic that we're participating in and how we're participating in, I just want to spend a bit of time talking about some more business inside the portfolio. My real thing today is with the volatility in the market, I want everybody, current investors and potential investors, to know what they could be exposed to and what they are exposed to in this fund. Equinity Group at the top there. You think of companies today, there's a real explosive growth in regulation. It's good or bad, but regulation is continuing to expand, and companies are also looking at how they can digitize their business and take costs out of their business. When you think of Equinity, and just to put in context, there's computer share and link here domestically. That's basically what Equinity is. Equinity has 50% market share of the UK share registry market, and right now over 70% of all new IPOs are using Equinity to come to market. Aston Martin recently came to market. They chose Equinity to be their provider. So that's a very strong business, but the most exciting part of Equinity today is that they recently bought Wells Fargo's share registry business in the US. Number 3 player with incredible blue chip customer base. And what they're going to do, it's right now in the UK, roughly the average number of products per customer is around 10. And those products are, risk factors, know your customer, KYC, a lot of compliance products that they've been developing. The number of products that the Wells Fargo business has is 2. So over the next few years, there's a massive cross-sell opportunity where Equinity is going to be cross-selling these products into that Wells Fargo customer base. And the CEO has talked to every one of those blue chip companies, and they all want and are demanding this digitization to come through. Equinity recently had their Capital Markets Day, and they confirmed their numbers at the upper end of their guidance. Equinity trades at 11.5 times PE and 8 times EBITDA. It's over a 30% discount to their domestic counterparts. Now, we've all seen all the OTT players, the over-the-top companies such as Netflix and Hulu and Amazon. Disney's developing theirs. CBS is talking about developing another one as well. A lot of these companies are developing these platforms, and what do they need to make them work is content. There's a huge explosion in the need of quality content today, and why it's important, it's Entertainment One. Entertainment One is one of the largest independent producers of content in the world today. They have an incredibly large pipeline of TV shows and films in their business. And to put it in context, Netflix is going to spend around $12 billion today, or this year, sorry, not today, this year in content. $8 billion of that will be in kids. Entertainment One has a $2.3 billion US market cap. It recently had its library, just their existing library, not future growth, valued at $2 billion. So you're not paying a lot for this incredible demand that's out there and the pipeline that they have as well. The real jewel in the crown that we feel for Entertainment One, though, is its family division. And today that's underpinned by Peppa Pig and PJ Masks. Peppa Pig last year did $1.3 billion of retail sales. PJ Masks did $1 billion. And that was up 3 times from the year before. So PJ Masks the year before last did $300 million. See, the growth in that business is exponential. We feel that those 2 assets alone can get up to around $2 billion of retail sales. Next year, we've got Ricky Zoom coming in. I always smile when I say Ricky Zoom because it's going to be a massive opportunity for Entertainment One. Around early 2019, we'll see Ricky Zoom come to the market, and we'll see them being rolled out globally as well. Peppa Pig's being rolled out pretty aggressively in China today. And one of Mary's companies, Alibaba, and Entertainment One are co-producing Peppa Pig movie that's going to be rolled out or launched in 2019. Why that's important? Next year is the year of the pig in China. So we're going to see a big growth in Peppa Pig for next year. When you think about those 3 properties that I mentioned, there's 7 or 8 more in the pipeline. And it gives us a lot of confidence on a business that's trading pretty much at its library value today of what it can be over time. Now, I talked about the infrastructure spend, and we've touched on Zayo Group and Interaction, Cellnex briefly, but I want to talk about Premier. If you remember, I talked about companies that are solving large problems of today. When you think of healthcare spending, it's one of the main things or main issues in the market. In the US, there's about $1.1 trillion of healthcare spending just on services alone. Premier is one of the largest businesses that is helping to address this spend. It's a group purchasing organization that has relationships with over 80% of the US healthcare and hospital systems. And what they do with that big buying power, they go to all the suppliers, like all your pharmaceutical companies, and say, look, we're buying on behalf of this. What deal can you strike with us? And what they're finding is that for every dollar spend that a hospital gives to Premier to do this in terms of the platform, they get a $17 saving, 17 to 1 ROI, which is incredible. But the most powerful part of Premier for us today is they have data on 45% of the US outpatient population. With machine learning and AI, they're going to be developing a lot of innovative products, and they're going to sell these products to their existing customer base. So that's a company that's solving a large problem today. I was asked, you think of a healthcare company like that, are they actually making money? Net cash balance sheet, 9 times EBITDA. Incredible value for a company with a long runway of growth ahead of them. So now that I've talked about some of the positions that we have, some of the mega trends that we're benefiting from today, just want to talk about a slide we put up at the AGM. It's gross returns over the last couple of years have been over 15%, which is great. And that said, the month of October has been volatile. There's no doubt about it. But I hope you've taken away from this when I talked about the stocks in the portfolio. There's some long-term thematics here that we're benefiting from, and long-term ideas which have drivers behind them, typically irrespective of the market cycles. So like you, we're conscious of market volatility, but with those companies I talked about, we're really focused on that asymmetric risk-reward. And I think that's really highlighted here in the upside-downside capture, which we're incredibly proud of. Since inception, the fund has captured over 80% of the upside movements in the market, while only being impacted by less than 30% of the downside. For me, that's a real function of that capital preservation, capital growth, looking at these long-term drivers and picking companies that have this asymmetric risk-reward profile. But like you, we're very focused on the market volatility, but I hope with the companies that we've talked about today, you can understand how our confidence level and our discipline around the long term has not changed. And I think it's an important point to leave you with here today, because the short-term movements in the market can cloud you and can make you lose sight of these long-term investment opportunities of tomorrow. So I thank you so much for your time today, and I hope I've come away with a bit of granularity of what we own, what you can be exposed to as potential investors, and what you are today as current investors. And we've been diligently looking at the portfolio, the risks around it, and we've come out even more convicted than we were before. So again, thank you so much for your time.